We just finished going through Jabil's FY26 Q3 earnings call materials, and now we want to share our takeaways with you. Here's the thing, everybody's chasing the flashy chip names, but nobody asks who actually bolts the AI data center together. That's Jabil, no brand, no silicon of its own, and yet the filing shows revenue ripped to 8.8 billion. On top of that, the company bumped its AI outlook all the way to 13.6 billion. The numbers look great. The real question is whether this growth is built to last. Let's dig in. Let me set the table on what this company actually is. Jabil doesn't design chips and it doesn't slap its own name on anything, yet it's the one building the AI room. The filing shows third quarter revenue of 8.8 billion, up 12% year over year, a clean beat. Core EPS landed at 3.60, up 24%, and adjusted free cash flow came in at 359 million. Four metrics all pointing the same direction. That's not luck, that's a machine running well. Here's the one that matters most. The company raised its full year AI revenue outlook to roughly 13.6 billion, up about 50%. The company framed it simply. They aren't abandoning the old business. They're stacking explosive AI growth right on top of it. And that's why the market's question has flipped. It's no longer will they grow. It's how durable is the quality of that growth. To get Jabil, you've got to get the EMS model, so let me put it in plain terms. Think of the tech brands as the author. They own the design, they own the IP, they own the name on the box. The filing lays out the trade-off. The author earns fat margins but eats brutal product cycle and adoption risk. Jabil is the printer. It owns zero proprietary IP and zero branded products. It just executes the manufacturing, the logistics, the quality control. And the company is upfront that this is a low margin game. Core operating margin sits at just 5.8%, so how does it win? The filing points to scale, cross-industry engineering leverage, and raw purchasing power. Here's the real puzzle the slide hands us. How does a thin margin contractor grab explosive AI growth without carrying the R&D risk of a chip giant? That's the question the rest of this story has to answer. Here's where the real moat gets built, and it's sneaky good. Jabil doesn't just want to make one part. It wants to expand from a single component to running the entire data center blueprint. Step 1 is the entry point. The company calls it the kitchen. You win the contract on one dominant capability: compute, storage, optics, or test equipment. Step 2 is rack level integration. The house, now you're adding power, liquid cooling, and the full physical build of the rack. Step 3 is facility management, the blueprint. You become the end-to-end general contractor for the whole room. And this isn't theory. The company states its second hyperscaler customer walked this exact path from one component to a full data center. A third hyperscaler is now running the very same playbook. Think about it. Once you're buried that deep inside the build, is the customer going to rip you out? I don't think so. A lot of folks think Jabil is just an AI story, and that's only part of it. It runs on 3 legs. Leg 1 is intelligent infrastructure, the AI engine. The filing shows they're 4.2 billion in revenue, up 21% year over year. The company tags that segment as the high growth, margin accretive vanguard, the tip of the spear. Leg 2 is regulated industries. The stabilizer, 3.2 billion, up 4%, and the company says the lift came from an unexpected turn higher in automotive. Leg 3 is connected living and digital commerce. The baseline, 1.4 billion, up 5%. Therefore steady, consistent cash. See the picture. AI sprints while the other two hold the floor. The company is blunt that diversification is still the right model, a natural hedge across different economic cycles. Our take, that stable chassis is exactly what lets the AI engine rev hard without the whole thing wobbling. Why do we call this quarter a turning point? Because 3 things landed at the same time. First, the company surged its AI outlook. The filing shows it went from 13.1 billion up to roughly 13.6 billion. Second, the legacy side outperformed. The company says automotive and connected living both beat its own conservative internal assumptions. Third, the full year guidance got raised. Total revenue moved from 34 billion to about 35 billion, up 17%. 3 upgrades all at once. That's not one division getting lucky. That's the whole machine firing. The company put it in 4 words. The model is working. Here's why that line matters. When a company can say that out loud, the market's question changes. It used to be, will they grow at all? Now it's, can they keep this pace? The bar just got raised, and that's the real story. This print was a beat in every corner, so let me walk all 4. Start with the top line. The filing shows 8.8 billion in revenue, and the company says that cleared the guidance midpoint by 250 million. And the beat was broad-based, not one segment carrying the whole load. which makes the quality on profitability. Core operating income hit 504 million, a 5.8% margin, with core EPS at 3.50, up 24%, and GAAP EPS at 2.59. Cash flow looks just as strong, 535 million in operating cash flow, only 176 million in net CapEx, leaving 350 million in adjusted free cash flow. Now the balance sheet, the filing shows 100.4 billion in cash and a comfortable 1.3 times debt to core EBITDA. That's a light load. And they still bought back 291 million of stock this quarter. Think about it: earnings, cash, a clean balance sheet, and buybacks on top. What's there to pick apart? 3 segments, but they aren't running at the same temperature, so let me line them up. The star is intelligent infrastructure. The filing shows it up 21% with a leading 6.1% core operating margin, and that margin climbed 80 basis points year over year. Inside that segment, networking and communications grew more than 50%. That's a rocket. Then the steady base regulated industries up 4% with a 5.6% margin, nudged up 10 basis points. And the laggard connected living and digital commerce up 5%, but carrying the lowest margin of the bunch at 4.9%. Here's the key thing the company is showing. The AI segment delivers both the fastest growth and the richest margin expansion at the same time. Fast and fat, that's a rare combo. Our read, AI is fundamentally restructuring the profit profile, cracking the old EMS margin ceiling that used to box this whole industry in. For 13.6 billion in AI revenue is a big number, but the number isn't the story the way they got is. Start with the base. The filing shows 525 AI revenue at 9 billion, and on top of that they're stacking another 4.6 billion this year. And the growth is broad, not narrow. The company points to test equipment seeing explosive volume demand. It also points to data center infrastructure expanding through new capacity in North Carolina and Memphis, plus networking winning across both InfiniBand and Ethernet. Now here's the part that should make you sit up. They're absorbing all of it asset light. The company says total CapEx stays at a disciplined 1.5 to 2% of revenue. Think about it, revenue sprinting like this while they barely touch the checkbook. How clean is that growth? And it gets better on margins. The company says high-value pieces like liquid cooling, silicon photonics, and power modules are structurally lifting the margins on that revenue. Past is past. Now let's look at what's coming. 3 catalysts the company calls a funded and active pipeline. Catalyst 1, the third hyperscaler. The company says it's secured in the data center space, contributing hundreds of millions in FY27. And it ramps fast. The company expects $1 billion plus run rate by FY28, replaying the exact path of hyperscaler number 2. Catalyst 2, capacity. The company says the global footprint is growing 10%, with the North Carolina plant hitting full speed in January of 2027. From there, it scales step by step. The company guides to $1 billion, then $2 billion, then $3 billion run rates over 1, 2, and 3 years. Catalyst 3, high margin M&A and storage. The Henley deal in modular power is delivering double-digit margins and recurring service revenue. And the storage business, driven by a second customer, is scaling far beyond what they originally projected. Notice the common thread. Every one of these leans toward higher margin, growth that gets richer as it gets bigger. Looking back is nice. Now let's see how the company prices the future. Start with next quarter Q4. The company guides enterprise revenue to 9.2 to 10 billion with midpoint growth around 16%. The AI engine does the heavy lifting. The company sees intelligent infrastructure jumping to roughly 4.9 billion, up 32%, a big sequential step. On profit, core operating margin is guided to about 6.4% at the midpoint, with core EPS pegged at 3.80 to 4.20. For the full year, the company calls for revenue near 35 billion, a 5.20% core margin, EPS around 1,021.70, and adjusted free cash flow above 1.4 billion. Now here's where I'll slow you down. The company itself stamps a caution on this. Every one of those Q4 and full year numbers is management guidance, not money in the bank. Execution is the variable, so don't go spending a forecast like it already cleared. So the question stares right at us. Everybody can bolt a GPU rack together. Where's the moat? The deck lays out the illusion first. The market hunts for proprietary tech, owned silicon, branded hardware. And the company flat out admits it has none of those, which on paper makes any single service highly replaceable. But here's what the deck says hyperscalers actually pay for: end-to-end integration breadth, compute, storage, power, cooling, networking, delivered with zero supply chain friction. That breadth is the thing that's genuinely hard to copy. Now the part you have to hold on to, the company is clear that asset light means no IP risk and low CapEx, but it does not mean zero inventory risk. The moat, the company says, is built entirely on turning reliability into a switching cost so high the hyperscalers just refuse to swap contractors. I'll take that's a real moat, but it lives and dies on flawless execution, nothing else. Alright, the pretty part's over. Let me lower my voice for the warning. First, what management actually backed. The company says FY27 AI growth percentages will mirror FY26 just on a much bigger dollar base. And it set a margin target, a floor of 6% plus. A deliberate step up from 526, 5.8%. Sounds solid, but now listen to what they would not say. Number one, and this is the big one, management flatly refused to guarantee total FY27 revenue would even be flat or up, citing ongoing pruning of the legacy segments. Number two, they refused to map any clear path to 7% plus margins. Number three, the company warned FY27's first quarter will see early ramp-up dilution. And one more, the company itself reminded the market that Q4 is seasonally the highest margin quarter. So that shiny 6.4% Q4 number, don't you dare straight line it into next year. The top line is euphoric, but radar wants you watching the dashboard. 3 lights are on. Light 1, inventory. The filing shows it sitting at 68 days net of deposits, above the 55 to 60-day target zone. The company says it's just timing issue in intelligent infrastructure that normalizes by Q4, and our take, that's a claim we verify, not one we trust on faith. Light 2, the supply chain. The company flags severe bottlenecks and stretched lead times in HBM and high-density PCBs. DDR5 supply is fine, but DDR4 shortages are looming, and when material jams up, can you ship? That's the worry. Light 3, concentration. Revenue leans heavily on a handful of hyperscaler CapEx cycles, and that big Adani multi-gigawatt project in India. The company says it has no definitive financial framework and is strictly an FY28 story, not a near-term driver. Don't pencil that one into this year. Let's pull up a level. Who really wins a gold rush? Not the miners, it's the guy selling shovels. That's Jabil spot. All that hyperscaler CapEx, the money has to land somewhere. Somebody has to physically build the AI boom. Jabil collects what the deck calls the manufacturing toll. And here's the beauty. It doesn't matter which chipmaker wins the war. The company frames the risk profile plainly. It's lower risk than betting on a single tech winner. But, and this is the catch, the upside is capped by the rhythm of hyperscaler CapEx. You only collect as fast as they spend. And that, our take, is exactly why the margin target is just a floor of 6% plus. So the ultimate question the deck leaves on the table, can Jabil turn all that integration breadth into real pricing power and push margins well past 6%? That's the whole ball game. Let's wrap it. The model's proven, so the question isn't will they grow, it's whether the growth holds up. Here's the 6-box scorecard. Box 1. The FY27 revenue guidance lands in September of 2026, and we watch whether management finally backstops growth beyond just the AI segment. Box 2. Margin floor. Does core operating margin decisively hold that 6% plus line and pull away from the 5.8% baseline? Box 3. Inventory. Do the days actually drop back to the 55 to 60-day target by Q4? Box 4. The third hyperscaler. Do we see clean progress from hundreds of millions in FY27 toward that billion-dollar run rate in FY28? Box 5, the ramps North Carolina, Memphis, and India coming online on schedule into early 2027 without nasty margin dilution. Box 6, Adani. Does that India gigawatt deal turn from a strategic intent into hard financial reporting? The numbers already prove Jabil grows, but these 6 our take decide whether it earns a RIA rating. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.